Welcome to episode 4 of NAAIM Confidential. This is a weekly series profiling members of the National Association of Active Investment Managers, where they share their investing wisdom and trading tips. Today we have Rob Hanna. Rob is an investment advisor representative with Capital Advisors 360 and is registered in the states of Massachusetts and Texas. Prior to joining his current firm, Rob managed his own private investment fund from 2001 through 2019 on a full-time basis. Rob also runs Quantifiable Edges, where he offers a subscriber letter and other services focused on quantitative market analysis. He's a frequent speaker at conferences such as the MTA, NAAIM, and AAPTA conferences, among others. Rob, welcome.
Thanks, Asher. Good to see you.
You too. So let's get right into it and start off by taking a look at the NAAIM Equity Exposure Index.
Yeah, came in a little high this week, right?
Yeah, it ticked up. So this week it was 87.36, a little higher than previous week of 84. Looks like it's been up there, except for 2 weeks ago, ticked down in a bit of a whipsaw. But we can also see that the market was a little flat for a few weeks around that time, and now it's back up. So
under the hood at that time, though, there was some selling, as I recall.
Oh yeah.
Yeah. I got an indicator I'll share later, but the index didn't go down too much, but we did see some sectors get hit hard, like financials. So maybe that was scaring people there.
Yeah, maybe there's a way to use this index in a structured trading model. I've taken a look at it myself, but Rob, you've done a few studies on this?
Yeah, I ran a little bit of analysis on it. If you want me to share it with you, I got a spreadsheet.
Sure, let's take a look.
Okay. See if I can figure out how to do it here. Oops. Okay, so can you see this spreadsheet?
Yep.
All right. So all I did is I broke it down and said, where's the exposure index at the end of the week, right? And if it's above 80, it goes into this bucket, and there's been 291 instances of that. And then between 60 and 80, 40, 60, 20, 40, and below 20. As we know, it can go above 100 and below 0, but it doesn't do either of those things all that often, I don't think. But they're included in the above 80 and the below 20. And what I found is that the kind of sweet spot is when there is some doubt, right? Like when it's between 40 and 60, those were strong numbers here as far as percent winners. When it's below, when it's between 20 and 40, that's when you had the strongest average profit. So this is $10,000 per trade when I ran it in my software. So this is basically saying like 0.4% on the week is the average week when it's down in this area. When it's been real low, it hasn't been contrarian. You've actually seen losses, which is interesting, right? So NAAIM members have been real bearish, and they've been right. Real bullish hasn't been as strong, but that's what happens with an overbought market, right? It doesn't scream higher a lot of the time.
Well, I think an exit signal is one of the most important ones to have, so that's good. And just remind me, this is a kind of a week-to-week trade that you're making, right?
Yeah, so this would be enter Friday at the close, exit the following Friday at the close, right? So it's just measuring each week. And this little breakdown just shows above and below the 200. If the S&P was above or below its 200-day moving average when the trade was initiated. So
can you gain more information with this indicator combined with the NAAIM Exposure Index?
Yeah, a little bit. Yeah. So what I saw here was, when you're above, when you're below the 200-day moving average and the exposure index gets real high, that could be a danger sign, right? Everybody's getting a little overexcited too soon. and then it is contrarian. It's not contrarian when you're in an uptrend. It can be contrarian when you're in a downtrend. And it may seem odd for some people that like a lot of these numbers are stronger below the 200-day moving average when you're looking at average profit loss, but volatility is higher down there. We've also got lower sample sizes because we've been below the 200-day not nearly as much since 2006 as we have been above it, right? But the sweet spot to me seems to be, somewhere between 20 and 60. You've got some doubt in the market and the market's moving higher. You got a pretty good chance of it continuing to move higher.
So if you feel like it's in that range and the next week, you feel like the index is bottoming out, finding support, that's the time to buy.
Yeah, that would make sense. Yeah.
Okay. Great. So what did you see in the markets this past week?
Well, we continued strength, right? We've seen I've seen a lot over the last few months suggesting that strength is going to continue, and we're in this period now where it seems we're overbought, right? But there's overbought and likely to go down, and then there's so overbought that you're likely to see strength beget more strength rather than strength beget weakness. And a lot of what I've been seeing has been those type of studies where strength is likely to beget more strength. And so that's what I saw this week. I got a few studies I can share if you want that kind of along those lines, or do you want to get into that later? Okay.
Yeah, let's take a look.
All right, so these are kind of in order of when they happened. So this was at the beginning of the rally in November. We had a Zweig breadth thrust trigger. And for those that aren't familiar, that's when the 10-day exponential moving average of the New York Stock Exchange up issues percent moves up above 61.5 after having been below 40 within the last 10 days. It's a pretty rare signal. It happens every few years. And what's interesting about it is just how good it's been. As you can see, 6 and 12 months out, the market's always been higher. And even in the short term, most of these numbers are really strong. 5 days out, it's higher almost every time since the end of 1962. So that was the first indication to me that, hey, we might be ready to launch here. And there were a few other breadth thrusts that came in around that time as well. I'm not going to go through everything. But this is one I like a lot when it triggers. Unfortunately, it doesn't trigger all that often. So when we do get it, it's not one that I would ignore. This next one looks at the number of constituents that are below their 50-day moving average versus above it. And when we see it get down to a real low number, like below 15%, and then shoot above 90% within a 50 trading day period, that's also been something that's shown real strong returns over time. And this triggered on December 19th. So about a month and a half after that Zweig breadth thrust, the market continued up, and a lot of things then moved, from that August to October sell-off, moved up into uptrends and above their 50-day moving average. And it happened, with so many of them that we got this to trigger. And as you can see, this has almost always been bullish over the next several months as well. And even looking shorter term, like 10 and 21 days, which is a month.
So would you say this is another measure of breadth?
Yes. Yeah. So this is just a raw count of S&P 500 stocks that are in downtrends versus uptrends, and this is just defining down and up as the 50-day moving average. You can use the 10, the 20, the 200, whatever you like. But this is one I found a while back that I've tracked for a while.
Okay, so two things kind of pointing the same direction.
Yeah. Yeah, and I've been having trouble finding things that have been pointing down. This is an indicator I use a lot, and I call it my NASDAQ S&P. This says relative strength indicator in the top here, but I've started calling it relative leadership indicator instead because everybody confuses it with RSI when I say relative strength. But this just tracks the strength of the NASDAQ over the last 10 weeks versus the S&P, right? And basically when the indicator is green, if you look down at the bottom of the screen here, that's when the NASDAQ's been leading, and when it's been red, that's when the NASDAQ's been lagging the S&P. And if we look at this table here, what you see is, going back to the end of 1971, the S&P's averaged 7.63% a year, right? When the NASDAQ's been leading, it's actually been 7.7%, and when it's been lagging, the S&P has actually lost a small amount of money when it's been the leader. So you really want the NASDAQ leadership.
That's interesting. This is almost a little contrary to those breadth indicators, because if it's the NASDAQ 100, that's a narrower selection of stocks than the S&P.
No, actually, no. This isn't the NASDAQ 100. This is the NASDAQ Composite.
Okay. Yeah. So it could be a broader market move.
Yeah. When Gerald Appel came up with something very similar to this. He used the New York Stock Exchange Composite, and I switched it around just a little bit from what he did. But the explanation for this or part of it is that the NASDAQ has higher beta, right? And so when it's going up faster. When it's going down faster. But the other thing to keep in mind there is that the NASDAQ also has generally smaller companies, riskier companies, and when people are putting money into those companies, they're not as risk averse, right? So, and when you're not risk averse, that tends to be a bullish thing for the market. So maybe those are some of the reasons why it works, but I guess we don't need to know the exact reasons, as long as we know it works and it keeps working.
Cool. I like this one. This is a Rob Hanna original.
It's bastardized from Gerald Appel, right? So I adapted it a little bit, but yeah, he was the spark for it. Interestingly, with the NASDAQs had an even bigger divergence, right? So the NASDAQs gained like almost 12% a year, 11.5% a year when it's been leading, and when it's lagging, it's lost 1.5% a year. So that tells you, if the NASDAQ's leading, you're better off being in the market. You're also better off being in the leader, right? So
makes sense.
Yeah. So this is one that I use in a few models that I run. I like it a lot.
Cool.
This was an interesting one that triggered for me a couple weeks ago. I have an indicator I call my capitulative breadth indicator, and it basically is just a count of triggers among S&P 100 stocks that they're extremely oversold and primed to bounce, right? And when it gets up to 11 or higher, I've shown for years that it tends to be a pretty good intermediate term signal. And that's what this is showing. So over the following 20 days, so it's been about 10 days since this triggered. So we got another couple of weeks here where it's been a pretty good signal. The market's gained 3.4% on average, and it's been up 89% of the time. And you can see we've got the big outlier here was the COVID crash in 2020, right? We saw a big spike in the indicator then, and it didn't help the market in time.
Sorry, Rob, you cut out there when you were introducing the indicator. What's it called again, please?
Oh, I'm sorry. It's my capitulative breadth indicator. I call it CBI for short. And what it does is it measures the number of S&P 100 stocks that are triggering what I define as capitulation, right? So they're really strongly oversold and they're trending at the same time. And so they're primed for bounces. So you get a lot of S&P 100 stocks that are primed for a bounce, you're likely to see the market bounce, and that's generally what's happened.
Cool. So far so good. Everything's pointing to higher highs.
Yeah, and that's basically what I keep saying. So this is another one that triggered on the 12th, it looks like, and this is the number of this says that the Russell 2000 closed in the bottom 25% of its 20-day range, but the S&P closed in the top 25% of its, right? So when that happens, you end up hearing a lot of people that say, oh yeah, the S&P is rising here, but the Russell's in trouble, and the bad breath is going to bring the S&P down eventually. And what I found is it doesn't in these cases. When you've got the Russell, it's kind of oversold, and this is similar to the CBI indicator, right? So we got oversold in mid-January by a few measures. And even though it was like hardly noticeable on the S&P chart, and that's kind of what has helped us, I believe, rally over the last few weeks.
Cool.
And then in the last few days, we saw a few things trigger. This is Stock Traders Almanac. They published their January barometer, and all it really is it says, are you up in January, or is January down for the month? And that kind of, as they say, as January goes, so goes the year a lot of the time. And I think I said to you, I've always doubted this indicator, but maybe that's why it's been so good. What you see here is that if January is up and you buy the close of January and then you just hold for the next 11 months and sell the close of December, there's been 38 winners and only 6 losers going back to 1950. And the average 11-month period has made right around 12%. So we've got this going for us too, right? Which is nice.
Yeah, looks like it did really well in the 80s and 90s, and while still positive, not as sharply positive in the more recent decades.
Yeah, and maybe that's just one of those things where people found out about it. Or, we've got some flat periods here as well, and those flat periods mean that there was a down January, so there was no investment that year. So there's also that. But yeah, there was more dips like we had here in, it was like 2001 maybe, or 2002. We remember that wasn't a great year. So yeah, there have been some, it hasn't been as consistent as before.
Still, it's hard to argue with a curve like that.
Yeah. And now, so here we are 3 months later after we've, started that launch at the end of October and into November, and the S&P is up over 15% over the November, December, January period, right? It rose 15.5%, and that triggered a study I did a few years ago. And this just shows all the other times that the S&P has risen 15% or more over a 3-month period. And what we see here is, again, looks really good once you look out, 3, 6, 12, 24 months. Those are some really high percentage winners and some nice looking average returns too. 6 months of 12% and 12 months of 17%. So I'm continuing to see a lot saying that momentum is strong, and it's probably going to continue.
But certainly not at the same pace as the last 3 months. Looks like it does slow down, but still a reliable indicator of the direction.
Yeah, we got to pause here at some point, right? And refresh. It's not like to the moon, baby, right? Was it Dogecoin to the moon? That's what they used to say.
Yeah, AMC, GameStop, all of them, right?
There you go. The GameStop movie just came out on Netflix. It was interesting to watch. I saw that over the weekend.
Oh, good. Looking forward to checking that one out.
Yeah. Now, I had to throw in something bearish here, but like I said, I'm not seeing a whole lot bearish. But this is a chart of the SOMA, which is the Fed's system open market account, right? So when the blue line is the SOMA and the green line is the S&P 500. And generally what we see is when there's QE, that's when this is rising, and that tends to be good for the market. When there's QT and it's going lower, that tends to cause trouble for the market, right? And it did early here, and it did early here, like in 2022, and it did back in 2008 and back here. So, we'd rather have the Fed supportive of the market than going against it. I think over time, when I haven't measured it in a few months, but basically anytime the SOMA has been flat or lower, it's the market hasn't made any money net over the long haul. Everything's been made when there's been QE, looking back to like 2003, which is as far back as I could find data.
Yeah, it looks like it flatlines around 2015 there. It does pick up though, but a flat monetary policy along, it looks like it led to a kind of a flat and volatile market with some tops.
Yeah, and I think part of it, so this initial area here was, I think, the end of QE3, and you had that issue there, and then they got into what they were calling Operation Twist for a while.
Oh, right.
And that's what this is. So this is a lot of little up and down that you can't even see it anymore. But that was an interesting period as well. The market did fine with it, and then they started some QT here, and we hit some hiccups again.
The taper tantrum, right?
That's what it was. Yes, taper tantrum.
Yeah, I love macroeconomics, and I love thinking about the Fed's effect. I've seen a great correlation with the market price to M2, and of course you can't directly control M2, but you can the Fed can influence M2 with this monetary policy. So this looks like a good indicator of something that affects M2. But I'm curious, do you have any theories about what the Fed was doing before QE1 with this account? In Economics 101, I'd always just learned about the Fed controlling the Fed funds overnight rate, but it looks like they were still playing around with this account even before they had to get into QT in response to the global financial crisis.
Yeah. So it's interesting. Like they had I don't know if they still have it on the website, but back when I started pulling it back in like 2009, they had it going back to 2003. And what you see here is this period of time from mid 2003 up until 2007, they weren't calling it QT, but the SOMA was rising gradually during this time. And for whatever reason, when the global financial crisis was just about starting to hit, they said, all right, let's reduce the size of the SOMA now. And they did it in a pretty big way, right? And I think that probably exacerbated things. And then they figured out, hey, this account we can really do stuff with, and they jacked it up and off to the races we were. So I don't know if this was an experimental phase or if they, if it was nothing more than just they've got an account and it's growing bit by bit there, but there was no huge effort until you see here with QE1.
Maybe an unintended consequence. I remember weren't they raising rates during the Great Depression until they figured out that was the wrong thing to do?
Yeah, I think you're right. Yeah. So yeah, always interesting. I had one other interesting, or I found interesting chart to share here, and this is just the VIX futures. So this is as of yesterday, February 1st, and what we see here is, normally you get like, you'll see steepness on the front and then it flattens out at the back of the curve. But right now, the back of the curve is where we see the biggest steepness in the futures. And the reason for this is we got an election coming. So this is the September futures. This is the October futures. And when, when the VIX, so this is saying in October, the VIX is expected, based on futures prices, to be pretty high. And the reason for that is when you're in mid-October, the VIX measures option prices 30 days out. And during that 30-day period, you've got an election happening, right? So there's going to be a lot of uncertainty in the market at that point. And that's what's causing this spike in VIX futures. So we'll see. This could be an interesting time.
Certainly, and definitely looking forward for the next month to come out so we can see just how kinked that curve is.
Yeah.
But 20 doesn't seem like a very high value for the VIX. Why do you think it's not above 30, given such a potential for volatility then?
Well, 30's really high. It may not seem it, but like what the VIX is measuring is implied volatility in the options, right? So it's the best estimate we have of what realized volatility is going to be, and it tends to, you tend to have the whole curve being pretty low when you get into these periods of time, like we are now, where we haven't had huge volatility. Realized volatility. Sorry, I'm looking over here. Right now is around 11 if you're looking at 1 month, and so implied's normally a little above that, and then you do get this kind of action happening, but and a VIX of 16 suggests you've got about a 1% move each day over the next 30 days. And we haven't had a whole lot of 1% moves, and we've had in the last few days. But the VIX of 32 means we're estimating close to 2% moves. So you don't get VIX readings up into the 30s, 40s, 50s unless you tend to get into this kind of market where you're getting big moves back and forth actually every day. We saw that in 2020. Right, when we were up and down 5-10% each day, it seemed, and then the VIX launched up to 80, I think, or around there was the highest on a closing basis, maybe 82 or something like that. But certainly, if we start getting more realized volatility, the whole curve will shift up, and I think this will probably stay, 3 points ahead of September or whatever it is for a while.
So we've just had calm markets overall lately.
Yeah, right. The day traders have been making their money by buying at 10:30 in the morning and getting out in the afternoon, right? And it's been happening day after day for a while. And that's a great game till it isn't.
Cool. Wow, this has been really great. I've got a couple just more general questions for you and your practice. How would you describe your this approach, like data-driven, quantitative? Is it kind of just technical backtesting? How would you summarize that?
We say quantitative, I guess, more than anything else, but yeah, data-driven. It's not, some of the models. So I run for myself, I run a lot of models for my clients. Many of them are short term, right? So they'll be there's a group of models that'll be in and out of trades within a week or so, right, or a few days, and they're a lot of them are based on short term indicators. And then I do some models that are more, you know, TAA type, where we're shifting from, you know, like it'll use the NASDAQ S&P relative leadership indicator to move between NASDAQ and S&P and models like that, or move into bonds, maybe once every couple months on average, or once a month. And then I also do a lot with the VIX. So we've got models that'll look to trade short volatility. We have some that'll trade short and long, although they're mostly short. And then we've got some that really look to take advantage of term structure, and they generate long vol exposure by doing option spread trades and calendars and things like that.
Cool. TAA, tactical asset allocation?
Yeah, I'm sorry. Cool. Half the time I forget what it stands for. So thanks for helping.
Technical analysis, something else.
It's something technical.
Cool. So I guess just a couple last questions. What's your outlook for the future of the markets and economy? Do you think it's going to be more of the same, or do you think there's going to be some structural changes to trading and investing?
Well, there always seems to be changes, right? So, you know, it's tough to anticipate what they're going to be. What I like to do is just kind of set up the portfolio in a way that we've got some models that can take advantage of times when it all hits the fan, right? So, you know, as advisors, we want to be able to, you know, get through the tough times with our clients, right? Because that's normally when you get fired, or they're firing somebody. So have some models that'll be able to ride out those tough times, or even, you know, make a little money in those tough times. You look like a genius, and then do it right when you know times are good. You don't have to. I never feel like I got to beat the market every time it's doing good. If we can do all right when it's doing bad. So you know, from my standpoint, I don't know what structural changes there will be, but I like to incorporate short-term strategies and VIX strategies and other uncorrelated strategies. We have strategies for shorting the market as well. A lot of them are fairly short-term, which they have to be if you're shorting. You know, some of the stuff that we short, unless you have inside information, which I don't. Although I did hear that, you know, I should, if you're on an airplane and parts start flying off, short Boeing.
Oh yeah, I grew up in Seattle, and I remember that merger with McDonnell Douglas. I remember a lot of Seattle-based Boeing employees were just sounding alarm bells back then. Boeing had a kind of engineer-driven culture, and McDonnell Douglas was kind of more about a you know, executive, chief financial officer-driven culture. And back then they were they're predicting that wouldn't work out so well. So hopefully they can sort out their problems and start building the best airplanes again.
Yeah, we kind of need airplanes. Especially ones that aren't held together with duct tape.
Okay, just a couple quick ones. Do you have a favorite investing quote?
Yeah, you know, my favorite one is Walter Deemer. It's when the time comes to buy, you won't want to. I always thought that was funny, and it really encapsulated what happens when we get into, you know, these environments where everything is so oversold, and there's panic in the streets. And really, those are the times where I've done a lot of studying, and I think as advisors, you know, members of NAAIM, everybody's like, okay, this is what we waited for, and that's what you got to talk to your clients about, right? And this is why we got some cash ready, and let's put it to work now, and this is a good opportunity. So, but it's tough to do in the moment. So, yeah, when the time comes to buy, you won't want to. I thought it was funny and appropriate, and I've always kind of thought of that over the years when we get into these markets.
And for the last one, maybe if you'd stop sharing your screen so we can have a
Sorry.
bigger view. And finally, Rob, where can people find you if they want to learn more about your company or get in touch about strategies?
Well, I'm at Capital Advisors 360. So you can find me at capitaladvisors360.com, and you know, we do have models and signal services for advisors and institutional money. And then additionally, I run the website quantifiableedges.com. So if you go to Quantifiable Edges, that's a newsletter and a blog, and I post studies like the ones I shared here, where you can get a little bit of information. You can also find me on X, right? It's not Twitter anymore. It's at well, it's at Quantifiable Edges, but EDGS, because I think I ran out of vowels, or ran out of space. You're only allowed, what, 15 characters or something. So you could probably just do a search on it and type in Quantifiable E or something, and it'll start popping up.
Great. Well, thanks again for joining us this week on NAAIM Confidential, and tune in next week for another profile of a NAAIM member.
Thanks, Asher. It was great getting to see you again and join you on this, and look forward to talking to you in the future.
Yeah, I'll see you. Hopefully, see you at the next Uncommon Knowledge Conference.
Yes, coming up April, right?
Yeah,
I will be there.
cool.
All right.
Take care.
Bye-bye.